Zacks Screen of the Week, an overview of a timely stock screening strategy aimed at helping you produce more profitable investing results. Increasing PEs for stocks on the move. That's what we're screening for this week with Kevin Matras, our top stock screener here at Zacks.com, head of our Research Wizard division, among other things that he does here, which we won't get into at this point. Looking for increasing PEs coupled with increasing earnings, that's what we're doing?
Right.
Makes a lot of sense, I think.
Yeah, it really does. Studies have shown that the best performing stocks over the last decade have seen their PE ratios increase by over 100% from their breakout point.
Okay.
The good news with all of this stuff is that you can use a stock screener to be able to find these stocks early in their breakout cycle to hop on board.
So give us some examples to illustrate the dynamics at work here.
All right, let's go to these slides. First off, let's say that you've got a stock and the price is at $20 and its earnings over the last 4 quarters equals $1 a share.
Okay.
The PE ratio will be 20. $20 divided by $1 equals 20 PE, right?
All right.
If the earnings rise, let's say to $1.25, for example, and the stock doesn't, then the PE ratio will fall. 20 divided by 125 now creates a PE of 16. If earnings go up but prices don't, that means the PE ratio will decrease. But again, typically as earnings increase, so should prices, all right? Next, if the stock rises and its earnings stay the same, the PE ratio will increase. So if the stock is now at $30, for example, and its earnings remain at $1, the PE will have increased to 30 as well. Once again, 30 divided by $1 equals 30. So if prices go up but earnings don't, the PE ratio should increase. But again, this scenario is usually short-lived because the demand for stock, right, its prices, the demand for stock typically only goes up when earnings are going up or at least expected to go up.
Okay.
Now let's say next quarter's earnings come out and its 4-quarter combined numbers show EPS at $1.25 and the stock has also increased to 30. The PE ratio will now be 24. 30 divided by 125 equals 24. That is a 20% increase in its PE from the first example. So if earnings go up and prices go up too, the PE ratio can also increase. The interesting dynamic is that as earnings increase, so should prices. As forecasts for continued earnings arrive, the demand for the stock should continue to send prices even higher. This scenario you will typically see play out, higher earnings and higher prices in most of your uptrends.
So let's see if I understand this correctly. The best scenario then is increasing PEs as long as it's being fueled by increasing earnings.
That is correct. The increasing earnings creates demand. So investors seem to be willing to pay more for earnings now because they believe that it will cost them more in the future for increased earnings down the road. And again, this increase in price and earnings really is an ideal way to spot, stocks that are potentially, doing something significant. You want to put these things on your radar screen right away.
All right. Believe it or not, there is a screen in all of this. So give us the parameters.
Okay. First, what we're doing is we're looking for companies where their current PEs are at least 20% higher than their PEs from 3 months ago, but we are making sure that they are not 100% higher. So that's the limit. So more than 20%, but less than 100% higher. Okay?
All right. Okay.
The next item is I want to see an increase in the most recently reported quarterly earnings, which is the recent over the last quarter. And then we also want to see an increase in the quarter's earnings before that, which is the last quarter over the previous quarter. Okay?
All right.
And for good measure, I also want to see last year's EPS growth to be greater than the previous year's EPS growth, along with projections for this year's growth to be greater than the last. And the thing that's interesting is that if you see prices rising without an increase in earnings, there's no reason to be able to see the price continue. So that is one of the reasons why we stick all of these growth factors into the screen, because you want to see both rising in tandem. Oh, by the way, too, this screen, it seems, I don't want to say complicated, but a little complex. This screen is available in the Research Wizard. It's already pre-made, and it's called SOW Increasing PE.
That's cool, just in case people want to go to it after they purchase their copy of the Research Wizard. All right, give us some examples of stocks that came through the screen.
Yeah, sure. There was a bunch of stocks. Here's some of them. You have Alcon Incorporated, America's Car-Mart, Fluor Corp, Martech Biosciences, and Torchmark. What's interesting is that all of these stocks are seeing their PE ratios increase. Of course, they are responsive because the price is going up, but their earnings are going up in tandem, and that makes these companies very interesting picks.
How many more were there?
I believe this screen produced maybe about 30 or 35 companies this week.
Okay. Do you own any of these?
I do not have any of those.
All right. If you want to see the other stocks that Kevin did not mention that have come through the screen this week, and the text version is where they are located, text version of Screen of the Week, that is, go to Zacks.com's homepage and scroll down the page until you get to Kevin's picture. Click on the headline next to it. It will take you to that information. And as Kevin alluded to a little bit ago, he uses the Research Wizard, the stock backtesting tool. It's a very powerful tool. It's a screening backtesting piece of software to achieve all of these screens that he outlines for you here. And if you want to know more about that tool, go to Zacks.com/Research Wizard. With Kevin Matras and the Screen of the Week, I'm Terry Ruffalo.